everyone, this is Ruth the Forex Lady here with another video, and today we will be speaking about trade planning. Now, when we're talking about trade planning, we have to take into consideration a couple of ideas, and I'm going to be sharing with you guys the ideas that I personally look at. Now, you would have heard the old cliche, trade your plan and plan your trade, and that is what we're going to be going through, what it means to plan your trade. Because if you fail to prepare, then prepare to fail. We absolutely need to plan exactly what we're going to do before we enter the market. Because in order to be successful, one of the things that we need to have is a competitive edge. So the first thing we're going to be looking at is a directional bias. So when you come into the markets, I'm going to be looking for an idea as to what direction I will be looking to enter. So, for example, if I'm looking at gold, I'm seeing that my 50 is below my 200, which means that I'm looking for a selling opportunity. If I'm looking at, let's just say, USD then I see my 50 is above my 200, which means I'm looking for a buying opportunity. It's as simple as that. Now, does that mean that if I come into the markets and I see that I'm going to enter instantly? Absolutely not. We need to look for the best possible entry, which more than likely comes from some type of pullback. The next thing we're going to be looking at would be an entry trigger. Now, most of the entry triggers that we look for, which will be covered in another video, tend to be something that you're looking for that tells you that it's time for you to enter. Now, some persons may look at an EMA cross, an EMA crossover, meaning price crossing the EMAs or two EMAs crossing each other, or an area of around support or resistance, or probably even supply and demand or anything like that, or probably even support at an EMA or something like that. Like I said, I'll be covering that in another video. So once you have your directional bias, then you're going to have your entry trigger. So you come into the markets and you say, okay, I'm looking at USD and I see that my 50 is above my 200, so I'm looking for a buying opportunity. So the next thing I'm going to be looking for is my entry trigger. Now, while you are waiting for your entry trigger, this is where you're going to start looking at your account size. Based off of your account size, then you're going to be looking at our next point, which is lot sizing and your stop loss. Now, your lot size and your stop loss goes hand in hand. So, for example, if you have your lot size, if you have a particular account size, your lot size should reflect as such. So, for example, if you have a $100 account, I don't expect you to be trading 50 standards. Similarly, if you have a $10,000 account, I don't expect you to be trading 10 cents unless, of course, you're practicing a particular strategy. So obviously with your account size, excuse me, with your account size, you will be looking at what lot size is going to be appropriate and as a result, your stop loss. Now, why am I saying this? For example, you have a $100 account and you said on this particular trade, I'm willing to risk 10%. 10% of $100 is $10. So you decide you're going to be risking $10 on this particular trade. You're looking to trade a pair like gold. Based off of your strategy and your analysis on this particular trade, let's say your stop loss is going to be 100 pips. So because your stop loss is going to be 100 pips, obviously you cannot put a mini, because a mini on a $100 account is going to be $100 and you're going to annihilate your entire account. So if you have a stop loss of 100 pips, obviously, and 100 pips with a $100 account, then you would absolutely need to trade 10 cents. Similarly, if you were trading a pair like, let's say, USD CHF, based off of your analysis, you might say, you know what, USD CHF, I can comfortably place a 10 pip stop loss on this. Because once again, you're only risking 10%, then what you can definitely do is put a mini on that, because a mini lot at 10 pips is going to risk $10 on the account. So your account size, your lot size, and your stop loss are all entangled in one. The next thing you're going to have when it comes to your trade planning would be your target. Some persons use multiple things for target. Some of you guys, I know that you guys may use, let's say, EMAs. If you're doing counter trend trades, you can say, okay, I'm going to take this down to the 200 EMA. Some persons look at quarter points. Some persons look at support and resistance. Some persons look at supply and demand. Some persons use a fixed target like 50 pips, 10 pips, 15 pips, 100 pips. So obviously, when it comes to your trade planning, you absolutely need to know what is the target of your particular trade. The final thing, and which I think is the most important, would be your trade management. Now, your trade management is where you really make your money. Trade management has to deal with what you do after you enter buy or sell. So you come into the market, you have your directional bias, you have your entry trigger, you have your account set, you know how much money is in your account, you know what is the lot size you're using, you know what's your stop loss, you know how much you want to go for. Now you have to do your trade management. Now your trade management has to deal with, like I said, what you do after you enter buy or sell. So some persons, they have a set it and forget it mentality. Stop loss, take profit, whatever the trade does, it does. Some persons, on the other hand, may say, you know what, I'm going to enter this trade. However, if it pulls back a little bit, I'm going to add entries closer to my stop loss. So as it goes down, I'm going to maximize and capitalize on some more profit. Other persons I know, as it goes more into profit, they may add more entries. So as it continues, they capitalize as it goes toward their take profit. Another way to manage a trade could be once it goes into a certain amount of profit, you can move your stop loss across the line to break even, whereby even if it does reverse, you would have not lost anything, but you would have just broken even and you would have still made some type of profit. The final way that I know some persons manage their trade is by simply trailing. I know some persons, they trail 5 pips behind, 10 pips behind, 50 pips behind, all depending on the type of trading that you're doing. If you're swing trading, definitely you can trail 50 pips behind. If you are intraday trading, you may want to trail 10 pips behind or 15 pips behind. So in the event price decides to reverse, you know that you definitely have that covered. So, with that being said, our trade planning, we definitely want to look into our directional bias, our entry triggers, our account size with our lot size and stop loss, the target that we are going for, and definitely ways of managing your trade. So, I want to thank you all so much for spending this time with me, for listening to my video, and I will see you guys in the next video. Bye.